I would like to welcome now our today's experts, because I explained each masterclass will invite guest experts to give a kind of 30-minute, 1-hour thought-provoking presentation. So Michael is a climate finance specialist with more than 30 years of experience in sustainable urban development policies. He has worked with all multiple development finance institutions you can think of, from international organization, UN Habitat and OECD, to the ADB, Great Climate Fund in particular, but not included, not just in the Asian region. So Michael will provide you with a first overview of funding and financing sources. And in the second part of this masterclass, we will dig into several green financing instruments that have been mentioned already, that can effectively power green city projects. And again, there is no right or wrong. There is a lot of option because a lot of projects call for different solution precisely based on the ability to generate return. I will stop here and step back a little bit. Again, a warm welcome and thank to Michael. Over to you, Michael.
I hope that I can give a introduction to financing, and that we can dive into more detail as you go forward with your projects. I'll start to share my screen now. And then can you see the screen now?
Yes, definitely, Michael.
Yeah, okay, great.
Could you make it full screen maybe, Michael? Thank you.
Yeah,
okay.
Is that right now?
Yes. Okay,
great. Okay, thank you. All right, so as Margot was saying, this is an introduction. There needs to be a lot of digging detail into the various potential financing structures for specific projects. But today we hope to kind of get an overview of the concepts and the actors and the instruments. So basically what I'm going to do is to look at definitions and the context in terms of financing smart cities, looking at sources of funding and financing. Then we'll have a break, and then we'll talk about, after the break, we'll talk about green financing instruments and a more in-depth discussion about projects after that. And then finally, we'll conclude. So in terms of the basic definition, it's really important that we get a clear idea of what SMART is. SMART is not just about sort of fancy digital technologies, although that's part of it. It's the optimal use of resources and the smart systems and smart infrastructure, and looking at smart processes that do not necessarily have to be digital, but also smart financing. When we come to green instruments, green investments that are needed as part of this process, we need to look at that. If you're kind of wondering why I'm distracted, I can't get rid of that's better. The number of people on the screen. Right. Okay. Understood as actions, investments that will reduce carbon emissions or increase climate resilience or improve the environment for urban residents. Now, the reason that we make these three distinctions about carbon emissions, climate resilience, and improving the environment is that different financing flows are often deployed for one of those three things. So when we look at this green investments, we need to look at finance innovation. What are the kind of possibilities out there? We need to look at those possibilities in relationship to socioeconomic development of the city and the politics of the city, indeed, and the environmental needs, both from the point of view of the people within the city and the pollution, but also in relationship to the planet and the commitments that have been made by the national governments in terms of their nationally determined contributions and the impact of climate change on investments in cities. To put all this together, we need smart implementation, institutions, and systems. So in the end, what is smart green urban finance? It's defined as the flow of national and international financial resources, both public and private, committed to investments that result in the reduction of GHG emissions, support for adaptation, and or improve environmental conditions. It's important because one of those three boxes needs to be ticked, at least one, and when we're talking about green finance. So as we go through this presentation, I'll talk a lot about the supply side and the demand side of the green finance market. When we are looking at the demand side, we're talking about the entities that are making investments. And when we talk about the supply side, we talk about the entities supplying finance for those investments. And green financiers expect project to be not only financially viable, but also to achieve and document clear environmental outcomes and or climate benefits, such as GHG reductions or improvements in resilience. Now, this is important because basically a lot of these funding channels are contingent upon actual performance in these areas. If we look at what's happening in 2021 in relationship to green finance, looking at those three buckets, we see that climate finance is by far the biggest amount, and of that we see that green energy and mitigation of greenhouse gases is by far the biggest amount. Adaptation is much smaller at kind of 1/10 of the amount of GHG emissions, and elements of both mitigation and adaptation are another bucket. Biodiversity finance is coming together, and other environmental objectives that have the smallest amount at 3.5 billion in terms of international financing of green objectives. So you can see that climate finance is by far the biggest bucket, and therefore we need to, when we think about financing, we need to think about activities that can fall into the definitions of climate finance in particular. Not that the other areas need to be neglected. Often activities that undertake climate finance have biodiversity or other environmental, what they call co-benefits. So all three boxes can be ticked at the one time. The other thing that I think I want to really emphasize is that what investors are we looking at? On the demand side, what are we talking about? When we talk about urban investors, often we just think local governments, but actually the players inside a city are often not just local governments. They can be urban institutions like various utilities, water supply, public transport activities. So companies that are providing services, urban economic actors. What is the private sector doing? What are the main industries in a city? What are their impacts in terms of climate and pollution? What are the investments that they need to make? And then often state and provincial entities are important in a city. And this is very much the case in many countries in Asia, where national government entities or SOEs are having a major impact in urban areas. So we need to look at this range of investors and look at the kinds of investments that they need to make, and what are they in terms of what is the size of their investments, what are they legally able to invest in, what is their risk return profile. This was mentioned in the previous presentation. We need to look at what are the sizable investment proposals. One of the problems, particularly in intermediary cities, which we'll come back to again and again in this presentation, is that the size of investments tends to be quite small. And there needs to be some kind of aggregation, whether at the city level or across sectors, to be able to make them interesting to financing entities. Not always, but often. That means that often there needs to be an investable intermediary in this process, a fund or a funding agency, and there needs to be appropriate risk management. So in general, though, what can be the roles of local governments? They need to look across all of these potential actors on the investment side, and local governments can be consumers of goods and services. They can set the tone for the kind of investments that are needed. They are providers of goods and services. They can actually provide the green public transport and other services that are low carbon and or environmentally positive. They're raisers of capital. They can, with their budgets, they can influence where people invest and how they invest, and we'll come back to that. They're regulators that offer incentives. Particularly one of the examples that was just given was about land. That's one thing that local governments can do often to be able to influence both their actions and the actions of the private sector in the city. They can manipulate regulations, and that's something that is really important, and we'll talk about this in more detail as we go along. And they can be champions of systems thinking, looking at ways of integrating these activities, and that again was raised in the last presentation. So moving on to the kinds of sources of funding and of financing, one of the distinctions that we wanted to make at the beginning is this issue of funding versus financing. So it is really important to understand that there is a distinction. Financing is about getting money that you don't have. Basically, you're borrowing money, or you're getting money from other entities, and they are giving it to you under certain types of conditions and certain types of financial returns, and that needs to be usually repaid under so that either if it's a loan, it needs to come back as interest payments and principal repayments. If it's an equity investment, people want to get equity investments. We'll talk about what that is as we go forward. But the financing often depends on the funding basis of the entity that is doing it. So in terms of financing, we're looking at mobilizing capital from external sources in return for a future repayment of some kind. It needs to be paid back. The sources are financial institutions, venture capitalists, and other lending agencies, or even commercial companies who provide equity. And the financing is usually in two forms, equity or debt. We'll go into more detail on that later. On the funding, there is various ways in which funding can be raised. It can be raised through service fees. It can be raised through what we call own source revenue from the entity, through taxes if it's a local government. And then we're looking at utilization of that funding to either go into capital investment or into servicing financing. When we look at this chart, you'll see the way that funding can be used. So one of the issues for actual putting together a financial package in the middle here, in relationship to a particular investment, is that we need to put together that package in relationship to various financing sources. Later on in the masterclasses, I understand you'll be looking at ways of assessing what is the right kind of financing source and putting them together into a financial package. But that is something that the entity taking out the financing needs to be able to do. But also in relationship to the use of funding, that financial package is dependent on the amount of revenues that are available to repay the financing on the one hand. The total amount of the financing is dependent on the amount that the government budget or other grant finances directly, or how they use that funding from their own source revenues, etc., to use it as a first loss provision or a guarantee or insurance payment. We'll talk about that later on as well. And then it's also funding for technical assistance to develop projects, to build capacity, and to look at studies to actually put together the financing of a project. So this financing versus funding issue is really important, and we will talk about these parts of the picture as we go forward. Now, this is incredibly complicated. You'll get copies of this, but when we talk about the main sources of funding and financing, we're talking really about three major sources. We're talking about government budgets, international capital markets, and national capital markets, as well as the private sector in terms of their ability to put finance into a particular project. We see that there are a lot of actors at the international level: development cooperation actors, bilateral finance institutions, multilaterals like the ADB, etc., the Green Climate Fund and UNFCCC actors, and then the private sector. National financial institutions are really important. Now, some of these entities can provide finance at very cheap levels of cost, such as the development cooperation agencies. They may be able to provide grants. Those grants need to be used very, very carefully, and they need to be leveraging as much additional finance as possible. This is where we talk about the potential for blended finance. Blended finance is a way in which the cost of financing can be reduced down to a level where a project becomes viable. And this was talked about in a previous presentation in terms of if there is a gap between what is financially viable for a particular project and the actual revenues coming in, what is the amount of subsidy or grant that can go in to at the very margin to be able to make that project viable. And we'll talk about this again further on in the presentation. So we look at coming out of all of this, there is the official development assistance and new and additional climate finance that is currently being negotiated. There is another potential for carbon markets. At the moment, the voluntary carbon markets are about what's happening. The international carbon markets, the government ones, are using what they call internationally traded mitigation options are very limited. But the voluntary markets are a possibility in the future. And so all of these potentials can go into even a project within a local government, but we need to think about how we can tap them. There are various pros and cons of different sources. The traditional development partners like JICA, GIZ, AFD, etc., they provide TA and grants, but they're limited in the size of capital that they have. There's often long procedures and processes, and they're dependent often on government budgets. The IFIs like the ADB, etc., and the dedicated green funds like the GCF, they also have long procedures and processes and lack of alignment of frameworks and principles with the local government, but they can provide very large amounts of money. This becomes a problem, of course, because often they want to see big ticket sizes. National or subnational vehicles, national financing is still the biggest amount of financing for green investments. And the question is, how can cities get hold of that? How can they best provide the documentation for their projects so that they can actually get access to the national and subnational vehicles. And this is something that we need to look at in terms of how can projects be properly documented to tick the boxes that need to be ticked and in terms of getting access to green funds. When we talk about private sector, I won't go into detail on all of this thing. There are huge benefits in bringing in the private sector if it can be done in an efficient manner. There are many different modalities in terms of PPP, direct investments, etc. And there are important advantages that PPPs and other private sector involvement can be providing. They can provide commercial capital, hybrid capital, concessional capital resources. Commercial capital is contributed by institutional investors like pension funds and insurance companies. There are a range of companies. The thing is that projects need to be structured in such a way that these type of investors can get into the structure of the implementing entity and derive a profit. This is sometimes very difficult for local governments to put together. There are standard commercial investment instruments in green finance, which include debt and equity. There can be de-risking. We can look at guarantees and insurance products, and there are catalytic instruments to mobilize private sector capital, including blended finance structures, which I talked about before. There are, as we talked about, some of the issues on the supply side of the climate finance market. There is a lack of investment opportunities matching investors' risk-return criteria. Project development is critical, and this will come back again and again. A lack of investor capability in terms of short-term orientation, a size of available funds, whether they're too small or too big, regulatory barriers, and lack of appropriate financing vehicles, and the conditions for investment. So basically, financial institutions are constrained, especially in relationship to intermediate-sized cities, to be able to reach out to them and provide the required finance. On the demand side, there's a lack of long-term integrated planning on green investments. There's a lack of capacity to formulate and implement the projects. There's a lack of willingness to take on debt. There's a lack of willingness or a mandate to raise fees and taxes. And there is a lack of ability to influence commercial conditions like land use controls, etc. And yet, in particular with land is the one asset that cities often have control over. As was stated in the last presentation, so I won't go into detail, there are preconditions for private sector finance. There needs to be a good business case. There needs to be an acceptable return on equity and or debt. And this is a challenge because different financiers have different mandates, different ticket size, how much they will fund, minimum and maximum, and what their return expectations are. There is a risk for the private sector, and the risk for the private sector needs to be definable and containable. So to get into the market, they need to look at markets that they often see that the markets are fragmented and it's relatively small project size. There's a high cost for clean technologies up front, and there is quick development of new technologies, so there is a risk that you might invest in something that is going to be obsolete. There's a lack of capacity in municipalities to deal with complex project structures, and sometimes, although things are getting better in Asia, the law and regulatory framework are lacking. This is being addressed by countries in Asia, and things are getting better generally. So just to summarize, there is potential to fund better in relationship to mobilizing finance, looking at generating additional own source revenues. When I've been working for the ADB, one of the things that was the first thing to do was to collect the taxes that you are actually entitled to collect. In Quezon City in the Philippines, one mayor turned around a huge public sector deficit to a public sector surplus simply by collecting the taxes he was supposed to collect. And so there is the first step in maximizing your own source revenue. You need to improve local public finances and look at what are the green finance expenditures that you're doing and how efficient they are or not. Looking at national mechanisms, and local governments sometimes see that this is outside their purview. But in fact, if local governments get together and negotiate with national governments, often it's possible to put in place mechanisms that will support their activities in relationship to green finance. In Malaysia and the Philippines, we'll talk about some examples, that has been done. Internationally, the IFIs and ADB, World Bank, etc., are very, very focused on being able to increase their green financing. So just very quick examples of land-based financing. There is one that I want to use in London, can be used in other countries have been using it as well, but not very much in ASEAN. London funded 32% of its Crossrail Metro line through 3 different types of land-based financing. Land-based financing is any kind of financing which depends on the value of land, and usually it's mobilized through some kind of tax or supplement to a tax. In London, they use 3 types. There's a business rate supplement, there's development revenues and development application charges, and there's a resale of separate surplus land. Now, importantly, for the political acceptability of these things, these mechanisms were effective in that they focused on businesses and developers that directly benefit from the infrastructure, and they also focused on entities that could afford to pay the taxes, not on the poor and the vulnerable. In China, and as use of another example, there was a rundown portion of land, but it was zoned for basically heavy industry. The local government rezoned the land and divided it into smaller parcels that could be developed by local developers. They increased the floor space ratio 3 times, and thus increasing the buildable area by 3 times. And the city's revenue greatly increased by collecting a tax on the rents. Now, in China, they don't have a functioning property tax, but in other countries, it could be done directly through the property tax. So this issue of rezoning and upzoning and then taking advantage of the additional revenue from the property tax is a viable mechanism. In Sweden, local governments, because they have small individual investments, they're banded together and they have a cooperative bank that issues green bonds, so that the green bonds can then, those municipalities then go to this cooperative bank and get loans, much smaller loans, to be able to do their own projects. But the amount is a lot. There is over $8 billion of AAA rated green bonds that are currently outstanding. So there is this is what we talk about aggregation, and it's a joint effort of multiple cities that can be able to issue financing for its green investments. In terms of blended finance example, this one I was involved in myself. In terms of China, ADB, together with AFD and KfW and the Green Climate Fund, which supplied the majority of the very concessional financing, put together a provincial level financing activity. And because there was cheap money involved, we had mechanisms to only provide the minimum amount of subsidy that was needed by a particular project. And we also had vetting mechanisms to make sure that projects were absolutely green, and we gave incentives to make them greener by reducing the interest rate if the project achieved the highest rates. So we had aggregation, we had blended finance, and we had leveraging of government activities. So that's about where we wanted to get up to at the moment, and I'm going to come back and provide you talk a bit more about specific types of instruments, etc. after the break. Great, thank you.
Thank you, Michael. I think it was indeed very rich and quite a lot of information. Again, you have live interpretation, so please feel free to ask a question. They will be translated, and Michael could provide. It could be sharing some kind of feedback on challenges you face through your project, explanation of a concept that you didn't get. I know that a lot of you have already identified sources and want to tap into private sector investment through PPP or climate finance without always knowing how to reach out to them, what are their expectations. And I think something that could be useful, it's you talk a lot about the scale, but could you give a range of an idea of the ticket size, minimum ticket size that you require for, let's say, development bank, for instance?
Yeah, okay. It was funny because when I first got into the Asian Development Bank, a small project was like $20 million, and a kind of reasonable size project was $80 million. And now a small project is like $200 million, and a reasonable size project is 500 to a billion. So the size of the IFI investments that they would like to see has grown a lot. You know, in that time, ADB's financing per year has gone from like 4 billion to 15 billion. So this is why they need to see big size activities. But that does not mean that projects at the local government level need to be that big or anything like that big. Basically, the idea often now is that projects can be intermediated by national financing institutions, and those national financing institutions have much smaller ticket sizes. And those ticket sizes can be from 2 million, sort of, you know, 5 million, etc. And again, for some local government, that's a big number. But for the size of infrastructure that we're talking about, even in intermediate cities in Asia, that is not too big, or too small, I don't think. It's an amount that is reasonable. The development banks like KfW and AFD provide smaller intermediary loans to cities and either directly or through financial institutions, and so their ticket sizes are smaller, but still not very small. And so we're talking, you know, again, 5 to 10 million minimum for the international banks generally. So that's the kind of range. When we're talking about funds, you know, these days a private equity or other kind of, you know, private debt fund, you're looking 200 to 500 million. And so that we again, there needs to be ways of aggregating projects to get into those kind of funds. And usually it's through local institutions. And it can be local banks, local leasing companies, which is an area that has not been thought about much. And so that's the way. International finance often has very big ticket sizes, but then there's an important role for the national intermediaries to be able to break that down and to get to the local governments.